Two guys, same town, same age, same $50,000. One of them just made 47% in a single year. 47. His account went from $50,000 to $73,500 in 12 months. The other one, he made 10%. Boring. Predictable. 10. So one of them is clearly winning, and one of them is clearly wasting his time. Right? They both think they know exactly who that is, and they're both wrong. Because the one who made 47% is quietly on his way to losing this race by $250,000. Let me show you the real math. Let's keep this fair. Meet Marcus and Ben. Both are 30 years old. Both live in the same city. Both start on the exact same day with the exact same $50,000. No trust fund, no secret advantage. Same starting line. Marcus becomes a day trader. 6 monitors, 3 energy drinks, charts that look like a heart monitor. He treats the market like a full-time job because it is one. Ben buys one thing, a total market index fund. Then he does something radical. Nothing. He checks it once every 3 months, mostly by accident. 2 men, 2 philosophies, 1 number that decides everything. Watch what happens. Year 1 belongs to Marcus, completely. He catches a hot streak. A few earnings plays, a couple of momentum trades, 1 lucky ride on a stock that triples. By December, his $50,000 is $73,500. Up 47%. Ben's account, $55,000. Up a whole 10%. Marcus is $18,000 ahead. He posts a screenshot. He tells you the index is for people who are scared. He says, and I'm quoting every trader on the internet here, compounding is fine for boomers, but I'm doubling my money. And you know what? In year 1, the scoreboard agrees with him. But feelings and math are 2 very different things. Here's the number everyone talks about. That 47%. Here's the number nobody talks about. What actually landed in his pocket. Because Marcus's $23,000 gain is a short-term gain, held less than a year, every single trade. So it doesn't get taxed at the friendly 15% long-term rate. It gets taxed as ordinary income, around 32% once you stack federal and state. That's roughly $7,500 gone to taxes. His 47% year is really closer to a 32% year after the government takes its seat at the table. Now run the clock forward. Year 2. The market chops sideways. Marcus, trading aggressively, is down 28%. Painful, but completely normal for an active trader. He drops from 66,000 to about 47,000. Ben, up 9%, 59,900. Watch the scoreboard flip. By year 2, the boring guy is already ahead. Year 3, Marcus grinds back with a good run, but pays short-term taxes again. He's sitting around 52,000. Ben is at 66,500. Year 5. Marcus, after 2 more choppy years and another tax bill, is at roughly $58,000. 5 years of 80-hour weeks to turn 50,000 into 58. Ben, doing nothing, is at 80,500. Year 10. Ben's index fund crosses $129,000. It has more than doubled while he slept. Marcus, exhausted, is hovering around 65,000 if he hasn't blown up his account entirely. And year 20, Ben's 50,000 compounding at the market's long-run average of about 10% becomes $336,000. Marcus, even if we're generous and give him a net 3% a year after taxes, fees, and losing years, ends up around 90,000. 336,000 versus 90,000. The gap is $250,000, and the guy who won year one is the one who lost it. But the account balance isn't even the worst part, because there's a cost that never shows up on any screenshot. Time. Ben spent maybe 2 hours a year on his money. 2 hours. Over 20 years, that's about the length of 5 movies. Marcus spent 40, 50, 60 hours a week staring at charts. 20 years of that is roughly 40,000 hours of his life. None of this shows up in the return, but it shows up eventually. Because here's the question nobody asks Marcus. What if he'd taken a normal job? A $70,000 a year job, and just indexed his savings on the side, like Ben? 20 years of salary is $1.4 million in income he walked away from, plus the index growth on top. Day trading didn't just cost Marcus $250,000 in the account. It cost him a career. That's the tax you never see on the screenshot. Not the 32%. The 100% of a life spent chasing green candles. Now, if I only showed you the downsides of trading, I'd be doing exactly worse. Now, if I only showed you the downsides of trading, I'd be doing exactly what every finance influencer does. So let me be honest. There is a tiny slice of people who genuinely win at this. The studies are brutal. In one long-term study of day traders, about 97% lost money over time, and only 1% earned more than minimum wage. But that 1% is real. They treat it like a business, not a lottery ticket. Strict risk limits. A real edge they can prove over thousands of trades. Ice in their veins when everyone else panics. For those people, 47% isn't luck. It's a skill they've paid years to build. And indexing isn't magic either. It can go through a lost decade. Ask anyone who bought in 1999 and waited 13 years just to break even. Ask an entire generation in Japan whose market still hasn't recovered from 1989. Just hold the index assumes a future that mostly rhymes with the past. Usually it does. Not always. So this isn't trading is evil and indexing is holy. It's more uncomfortable than that. So when does Marcus actually win? When he stops pretending one good year is a strategy. The trader who survives isn't the one who makes 47%. It's the one who doesn't lose 80% the year after. Small edge, ruthless discipline, tiny position sizes. That guy can win. But notice, he wins by acting more like Ben than like the Marcus of year one. And Ben loses when he panics. If he sells at the bottom of a crash, if he turns his 10% machine off at the exact worst moment, his math collapses too. The index only works for people who can actually sit still when their account is bleeding red. The winner was never trading or investing. It was temperament, which brings us to the real trap. The real trap isn't day trading, and it isn't indexing. The real trap is confusing activity with progress. Marcus felt productive. 6 screens, fast fingers, a number that moved every second. It felt like winning. Ben felt like he was doing nothing, and doing nothing was the entire skill. We're wired to believe that the harder something feels, the more it must be working. Money is the one arena where that instinct quietly destroys you. The person clicking 200 times a day feels smart. The person clicking twice a year gets rich. 47% isn't a strategy. It's a mood. And you cannot compound a mood. So the next time someone shows you a screenshot of a monster year, don't argue. Just ask them one question. What was your return after taxes and after your time? Because that's the only answer that matters. Drop your guess in the comments. 20 years from now, is Marcus or Ben ahead in your gut? I read everyone. And if you're wondering what happens when the index itself hits one of those lost decades, when just hold stops working for 10 straight years, that's a completely different conversation. It's the one that scares me the most, and it's the next video. Subscribe so the math finds you before the screenshot does.